New student loan forgiveness update. The Biden administration announced $39 billion in student debt relief. In this video, we are going to go over who qualify, how you can apply, when it begins, how it works. Everything is in this video, so make sure you're watching till the very end and make sure to share with others. Welcome back, everyone. So happy to have you back for another update. Student loan borrowers can get lower payments from the new SAVE plan. If you sign up for the REPAYE plan now, you will automatically be enrolled in the SAVE plan before those payments resume. Remember, the payments are supposed to resume on your loan effective October. So you want to apply for that REPAYE plan now so you can be put in this new plan. The saving on a valuable education SAVE plan replaces the existing revised pay as you earn REPAYE plan. Borrowers on the REPAYE plan will automatically get the benefits of the new SAVE plan. This is why if you are not in the REPAYE plan, you need to apply for that immediately on studentaid.gov website. Now, the SAVE plan, like other income-driven payment plans, calculates your monthly payment amount based on your income and family size. The SAVE plan provides the lowest monthly payments of any income-driven plan available to nearly all student borrowers. Stay with me, it will make sense. The SAVE plan increases the income exemption from 150% to 225% of the poverty line. The new plan can significantly decrease your monthly payments. Your monthly payment amount is based on your discretionary income, defined as the difference between your adjusted gross income, your AGI, and the 225% of the U.S. Department of Health and Human Services poverty guideline. This means you will not owe loan payments if you are a single borrower earning $32,800 or less, or if you have a family of 4 earning $67,500 or less. Amounts are higher in Alaska and Hawaii. Borrowers earning more than these amounts will save at least $1,000 per year compared to the current income-driven repayment plan. Now, if you make your monthly payment, your loan balance won't grow due to unpaid interest. That is because the plan eliminates 100% of remaining interest for both subsidized and unsubsidized loans after a scheduled payment is made under the savings plan. For example, if $50 in interest accumulates each month and you have a $30 payment, the remaining $20 would not be charged. The SAVE plan excludes spousal income for borrowers who are married and filed separately. This means this change removes the need for your spouse to co-sign your income-driven application. If you are already enrolled in the REPAYE plan, or if you sign up for the REPAYE plan today, make sure to get on that. Go to studentaid.gov and apply for the REPAYE plan, the income-driven plan. You will automatically be put in the SAVE plan once it becomes available. The application for the new SAVE plan will be available this summer, and it states that they will notify borrowers directly when the application is available. Now, if you apply for any of the income-driven plan now, and you select the repay plan. That's very important. When you apply for the income driven plan, you must select the repay plan so you can be automatically placed in the new save plan once it becomes available. You can also select the option for your loan servicer to place you on the lowest monthly payment plan. This will usually be the repay plan. Now, income driven repayment plans can be found on studentaid.gov. It states here if you are already on an income driven plan, make sure you check to see if you are on the repay plan. Remember, that is the key. You must be on this repay plan. Log into studentaid.gov and go to your My Aid page. Scroll down and view your loans. Each loan will list a repayment plan. If you see that you are in the repay plan, that means you will automatically be enrolled in the save plan when it begins this summer. If you are on a different repayment plan, you will need to switch into the repay now or save once it's available to receive the benefits of the save plan. If you don't have a studentaid.gov account, make sure you create one. The save plan calculates your monthly payment amount based on your income and family size starting this summer. If you are making $32,800 a year or less, which is roughly around $15 an hour, your monthly payment will be zero. If you are making more than that, you will save at least $1,000 a year compared to the other income driven plans. Now, starting next summer, borrowers on the save plan will have their payments on undergraduate loans cut in half, reduced from 10 to 5% of the income above 225% of the poverty line. Borrowers who have undergraduate and graduate loans will pay a weighted average of between 5% and 10% of their income based on the original principal balance of your loan. Borrowers with original principal balances of $12,000 or less will receive forgiveness of any remaining balance after making 10 years of payments, with the maximum repayment period before forgiveness rising by 1 year for every additional 1,000 borrowed. For example, if your original principal balance is 14,000, you will see forgiveness after 12 years. Payments made previously before 2024 and those made going forward will both count towards these maximum forgiveness time frames. Now, borrowers who consolidate will not lose progress towards forgiveness. They will receive credit for a weighted average of payments that count towards forgiveness based on the principal balance of the loans being consolidated. Now, the income driven plans protect a minimum amount of income to ensure you are able to cover basic necessities like food and housing costs. Since the income driven plans are calculated based on income and family size, if your household income is below that level, you will have a zero monthly payment. Each time you recertify your income driven plan with updated income and family size information, you may see your payment adjusted. And this is how you can end up with a monthly payment of zero. If you have zero payment due, you do not need to pay anything that month. Just make sure you know your recertification date. Once the Save Plan application goes into effect this summer, they recommend you consent to the secure use of your tax information so they can automatically recertify your income driven enrollment for you. This way, you will never miss your recertification date and you won't have to fill out a recertification application. If you apply for an income driven plan such as the Save Plan this summer, your application will be processed in time for your first payment due date. All right, so make sure you apply